JLT, the juggernaut. I say besides an LLC trust, any other ways to reduce taxes? Oh, there are lots of ways to reduce taxes. Work with a tax attorney and an estate planner to make sure you're taking advantage of everything that you possibly can on business expenses. There are gray areas that you need documentation for if you're going to be, using those exemptions for when you file your taxes. I'm hopeful that, just like everybody else, that we get no capital gains tax on crypto. I don't know that that's going to be the case, though. So, some easy ones. I'll just throw out some easy ones. The Augusta rule. Okay, so if you have a family board meeting, your family members participate in the business in some capacity. If they're on the board or they're employees, you can rent your home up to 14 times a year to your business at a fair and equitable value based on what other homes in the same style home or venue rent for in your area. And you can pay that money to yourself, tax-free. Another one, section 7, is it 709? It's a tax form. 709 is the gift form. I don't know. Heavy vehicle, heavy equipment, and software. The number, the code escapes me at the moment. But vehicles over 6,000 pounds can be written off. A large portion of those, as long as Trump's in office, it's probably going to be 100%. But even after he leaves office, Biden was looking and made it where it was like 50% in the first year that you can write off. So if you are going to buy something to go meet people in or go view properties or look at investments on a regular basis, you need a normal vehicle that your family drives, and you do have to document the mileage on the vehicle that you're using and for what purpose. But that is another really big ticket way to be able to write things off. Cost seg on properties or investment on properties. Opportunity zones. We have a couple people that were talking in Carbon 2 just a few weeks ago about investing in opportunity zones. Section 179. Thank you. I don't know why I was thinking 709. 709 is a tax form. It's the gift form that you have to file with the IRS when you give things out of your personal estate. Section 179 of the tax code is for the heavy equipment. If you buy a farm and you buy a tractor, it's another good one. What else? The cost seg. Here's one that's really interesting I learned about the other day. It's called legacy soil depreciation. So if you're buying large swaths of land like Bezos and Zuckerberg and Bill Gates, you can use legacy soil depreciation and pull forward a lot of the depreciation on raw land. There's tons. The only thing that I would stay away from or be cautious of, because it's not always bad, there are legitimate tax credits. But anybody selling you tax credits, have your attorney look over it, or your tax or estate planner, just to verify things. There are legitimate ones out there. I will say that. But in the past, I've been approached by people that are selling tax credits that it works for a while, and then the IRS tends to catch up with those. It could even work for up to a decade while they compile a bunch of evidence against it before they come after people, and then you owe back taxes and fees when they overturn it. Just be careful if you're going to play in that area. There are legitimate ones, but make sure that you're working with credible counterparties and you've done your own due diligence with your advisors before taking advantage of purchasing. Like, a lot of them will say, invest this much money and you're able to write off more than that amount. Most of those are not true. Sometimes they sell at a discount, and then you're able to take the full amount of the exemption or the credit. I don't know. I stay away from most of that stuff just because I never want our clients to be exposed to something that we had an oversight on and we're probably a bit more conservative on things sometimes than. As an example, there was a gentleman that brought me stuff the other day. I wanted to entertain it. I wanted to believe it, but we have certain rules about certain levels of returns on stuff with our group, where if it's over a certain amount, we just say, nope, it's out of our risk tolerance. It's not worth the reputational risk if this ends up being something that is not legitimate. And you got to weigh that out for yourself too, right? So we're probably, as we progress here, there are going to be groups out there that have return profiles that exceed what we're looking at. And we will operate on the aggressive side, but we will do a ton of due diligence and make sure that if you are going to participate in that, maybe it's outside the scope of what we offer, but you at least understand the risks when you're making an allocation. And that's the benefit of working with our group, on the advisory side.